Our supporter for this episode is Quest Fund Placement. Quest raises funds globally for European private equity and private debt managers with a focus on the mid-market across Europe and the US. Quest has successfully raised more than 37 billion euros of primary capital over the past 20 years for leading managers including DPE, Procuritas, InVision and Systematic Growth. Quest's dedicated service is one of strategic advisory that's in tune with the dynamic regulatory environment and focuses on support, guidance and long-term client relationships. You're listening to Fund Shack. I'm Ross Butler, and today, backed by popular demand, I'm with Jim Strang, Chairman of HG Capital Trust and prolific private equity non-exec director, with responsibilities at firms as diverse as Bain, CVC Capital Partners, Hamilton Lane, the Business Growth Fund and the London Business School. We talk about a diverse range of topics, from fundraising, the medium to long-term attractiveness of the industry, GP strategy, private wealth, how to manage a semi-liquid vehicle, ESG, cyber. There's something for everyone. Enjoy. Jim, welcome back. It's been 2 years since you were sitting pretty much in that chair, and you said at the time that there was about to be a real shake-up of the private equity industry in terms of fundraising. The big guys were going to get bigger, others would find it difficult. You did say that the people like in the middle, let's say, would raise eventually, but it would be harder. Yeah. And all of these predictions have scarily come very true. My fear, though, is that there are some really good managers out there that have produced great returns for their investors year after year. And, you know, we're into a year's worth of fundraising winter here. And it's starting to feel a little bit like an ice age. What's going on, do you think?
Well, thanks for having me back, and also for ensuring that the temperature is at least 10 degrees cooler than the last time I sat in this chair, where it was about 35 degrees, which is no good for me.
We fixed a few things.
Yeah, well, you got to remember, Scottish people melt at 21. So anything above 25 is serious spacesuit territory. So I'm very happy that it's mild today. Yeah, I mean, I think that's kind of a fair summary, I guess, in terms of what's going on right now. I mean, and you know, there's actually some reasonably significant amounts of capital getting raised for the private equity business, and you know, as one of the sub asset classes of the whole private markets. But it has been a bit of a polarized market where you know, there's been a gathering of assets by platforms, and there's been the other people who've done well out of it are the sort of pure play specialist, absolutely top performing strategy has continued to sort of be successful, and then there's a sort of a gap in the middle, and that's where it's been harder. So, and it's almost, you know, there's a sort of a squash ladder of, as you go down the squash ladder, it just gets progressively harder and things just take progressively longer. So you see that. So you see the funds that have the massive platforms and scale effects doing well and going relatively quickly, and the very, very strong performers, again, doing well, going relatively quickly. And then it's like next layer down, probably getting there, just taking a lot longer. Then next layer down, maybe not quite getting there and taking even longer still. And then you kind of go down and down and down.
Is it just about returns?
Oh, well, I mean, the other key point is it's about the customers. Right, so the customers are sitting there quite overexposed still, right? So they're the LPs that participated particularly in the sort of the boom of 2021, have a lot of money in the ground, that a lot of assets that have yet to sort of mature and see liquidity. So, I mean, for them, it's still pretty challenging. And, you know, around the different geographies of the world, the challenges are different depending on which part of the world you're in. So the, you know, relatively different regions are in different degrees of discomfort around this illiquidity. But that illiquidity problem is still very much the case, and it's still got to work through. So effectively, it's almost like in the really aggressive years of 2021, we almost had like a doubling, like a double fundraising. And we're now sort of slightly working our way through it, and we're not all the way through it yet. So
I do remember you saying, you know, it's like grow. Is there a way to slow down? No one really could find a way to slow down. And so you had the real indigestion for the LPs. Now you got kind of, you know, starvation for the GPs at the other end. It just feels a little bit dysfunctional. But I guess the question still in my mind is this like purely a structural thing? And if you're patient enough, it will all work itself through the digestive system? Or is there kind of a change in LP sentiment whereby they've kind of lost there's kind of certain strategies that are just now out of favor, returns aside?
Yeah, I think, I mean, the longer term picture, I think, still pretty positive. I mean, I think, as you know, I spent a bunch of time with Bain and Company, and just looking at the kind of feedback they get from customers. I mean, one of the things which is great about the asset class is when you ask the customers, are your expectations being met or exceeded by what you're being provided? And the answer is significantly yes. So if you have a business where the needs of the customers are being met or exceeded on a sort of long-term systematic basis, that's very supportive of future growth, because effectively your existing customers stay with you and possibly do more. And then there's still a bunch of people that don't have exposure to the asset class. So they look at this and go, well, actually, there's a part of this asset class or this investment universe, which, the customers are sort of 80% plus net positive. I mean, it's quite hard. I can't really recall ever really talking to an investor who said, you know what, this private equity thing, not for me. I'm going back to index funds.
Yeah, you wouldn't get that impression reading the FT, but yeah.
It's just not been my experience anyway. The customers have said, this isn't working. I want to stop. It tends to be you get into it and then you figure out what your equilibrium position is. And that varies wildly, because one of the challenges that investors face when they do enter the asset class is it is quite difficult to figure out how much to have. What should your asset allocation be? Because everything from obviously zero at one end, and some investors are in the 20s or 30s percentage to their allocation, some even higher. So you can drive a bus through the gap and actually figure out what's the right place to be, which then segues a bit into the situation we have now, where people are working through allocation issues. But I suppose they're probably being a bit more thoughtful about it this time around than the last time we ended up with allocation or exposure issues, where there was more of an imperative to sell because people felt really uncomfortable about being through different guidelines in terms of levels of exposure. This time, I think they've been more comfortable to sort of let it ride on the basis that the public markets recover, and they have recovered. So some of these allocation challenges have sort of solved themselves by the markets stabilizing.
They must have built in some flexibility in terms of their own governing rules around the denominator effect.
Yeah, no, I think definitely, because I think, looking back in retrospect, where those hard rules were more dogmatically enforced in the last time we had a proper crisis, ultimately it didn't look like a very clever decision. In terms of the things did recover, and actually the buyers of those assets did incredibly well buying them at the point that they bought them. So the sellers this time around have gone, well, let's not do that again, and let's be a bit more thoughtful about the volatility or the allocations, and also the other thing around it from that period in time. And again, go back to why customers quite like this asset class. It's so resilient to the downside. I mean, I think I'm sort of quoting old Hamilton Lane data from where I recall it, but the sort of vintage year returns going back 20 years from private equity, the worst year is about 8% return. So if you say, let's show me an asset class where I can go back 20 years, individual vintage year returns, and the worst year is 8.
And no one ever talks about that. Everyone likes to, obviously, we want to talk about the upside and 20% IRRs, but it's and the public, let's say, perception of private equity and venture capital is, okay, sure, you do all that, but it's incredibly risky. And so that's a very powerful thing to know.
I mean, obviously there's deals have a risk of a capital impairment. And great managers do a really good job of minimizing that, but it's not zero. But funds, in fund level impairments, where you put 25 assets together in particularly a private equity fund, particularly of scale, that I'm sure you would see if you looked at the data, the actual capital loss at the fund level in a mature private equity fund, I'm going to say it's a very, very small number, certainly less than 10%. I'm sure we'll come on to it, but if we're talking about the wealth market, if you talk to a wealth manager and say, here's an asset class where it's a pretty asymmetric return profile, it's biased to the positive, I don't know how much you're going to make, but it's probably, pick a number, 10%. So here's a structure, 10% return, pretty minimal, hard to see how you lose your capital position. You wonder why they like it? I'll tell you why they like it. But relative to your best alternative, it's a pretty good option.
Yeah. Well, let's definitely come back to wealth. Let me just pick up on a couple of other things you said. So I guess it's is it surprising that there isn't a consensus around the right allocation percentage to private markets?
Well, there's a few things I think get in the way. So one is it's quite difficult to figure out how to model risk.
Yes.
Because public market risk is stochastic volatility, and because share prices bounce up and down, and for example, if you're
that's how it's measured. It not necessarily is fundamentally
right, but that is the doctrine of how it's measured is this volatility, and the reason that it's relevant is because your ability to make a bad decision is really high, right? So I would say to my students at LBS, like, if you know exactly the right time to sell any share that you choose, you're going to jail. Right, because the only way you can have perfect knowledge of the optimum moment to sell, is to be an insider. And effectively, in private markets, what you've done is you've outsourced your ability to make a bad liquidity decision to an insider, who's not going to do that other than at the optimum point of value creation, as long as they can stay in control. Right, so there's sort of in stochastic volatility, where you can make choices, and probably bad ones, any point in the day. Then risk matters, because you could decide at the wrong moment to sell, and you lock in the loss effectively because you've made that poor choice. Private markets, you can't do that. For the very much the most part, you're beholden to somebody else's decisions to create liquidity, and and also liquidity in private markets is like wholesale liquidity. So we don't sell shares in companies, we sell companies. Public markets sell shares in companies, and that's a very different thing. But in terms of the risk, the risk metrics for private markets just don't work, because it doesn't have stochastic volatility. So when you're trying to Pareto optimize, so what's my right allocation, it doesn't really work that way, because you've got something that's stochastic volatility on one side and something that doesn't. Because if you put in private markets into a stochastic vol model, it blows it out, because the share price or the valuations only move 4 times in a year, not 4 times in a second. So it just wouldn't work. So people struggle to figure out what the right way to do this, and it's something that it causes all sorts of consternation. I mean, that I saw a really interesting research piece that GIC created about maybe a year ago now, and they've got a research group who've produced some work on it, like a factor model. So a factor model is based around the kinds of sector exposure that you have, and they've got a mechanism, or they certainly have some tool that allows you to think about private market allocation using a factor model rather than using anything else, which I don't know what you would use. And interestingly, that if you look at the document, that the GIC allocation to private markets, if you're looking at their approach is 25%. So right, and they would say, look, the document says, look, if you look at the classic 60-40 portfolio, the mean variance optimized 60-40 portfolio, and compare it to the factor model with a 25% private equity allocation, then the factor model wins, the way they've done the back testing.
A factor model being, is it closer to effectively business strategy? You're selecting various characteristics and then mapping them?
I think it's probably driven by sector. So how different businesses in different sectors perform in different macro scenarios. And then you Monte Carlo it to death. So you have like hundreds of thousands of iterations to try and get to what some sort of outcome would be. People that are interested just go to the website and pull the paper down. But they have 3 portfolios. They have the 60-40 one, which is the classic benchmark 60 equity, 40 bonds. Their fact model, and they have another model, which is a sort of a subset of the second one. And then they try and do a mean variance of where would these models land you. And they, as I said, I mean, they're both superior. So I think, we're still trying to figure out how to implement this stuff. And indeed, no one seems to have a perfect answer, but it is a definite, we're heading in this direction of trying to understand what it might look like.
And the people that are most sophisticated, it looks like their allocation to private markets is radically higher than, well, certainly the average. Is that fair to say?
I mean, I certainly worked with investors in the States, in the US state pension market, who would be right up there at 25.
Right. Okay.
At real scale. But had been for a while. So, there are certainly those that run it way higher. And I mean, obviously, I think, people are probably aware the endowments in the US run it pretty high. But if you think about what we would see over here, would be very different. I mean, EMEA, you would be single digits. Relative, certainly, 10 would be a big number here. But in different markets, as you get more comfortable and you understand it perhaps better, then that number can creep up. And that's, again, supporting the growth. So we think about where's the growth going to come from? Well, say Bain would say $14 trillion industry in private markets as of today. Public bond and equity, I don't know, a couple of hundred. So, it doesn't take a massive delta of asset allocation into private to really grow it. 10 trillion, which would be 75% of the size of the privates, is a 5% asset allocation away from public. So that's like, yeah, exactly. That's right. So my maths is right. So you can easily see where shifts in asset allocation could be massively supportive. And then we haven't, somewhat baked into that is the wealth effect, or the wealth, the amount of dollars in the wealth market that could act as a supercharger.
So you've done some work with Bain on GP strategy as well, which is, I guess, an oxymoron. What have you been looking at there?
Yeah, really busy with it. So the Bain built a vertical. I used to work at Bain a long time ago. But they built a vertical called FSO, which is Fund Strategy and Operations. Because inside the private equity group at Bain, where I worked all those years ago, about a third of what we do now inside that group is working on these topics. And broadly, what it all boils down to is, as GPs are thinking through, many of them are thinking through where they go from here. So, it's been an industry's been on an incredible run. It's had incredible success, but in a couple of decades since that inflected up really in terms of growth, firms have got bigger, funds have got bigger, industry's got way more complicated. It's a multiple asset class industry now, and this notion around for the have-nots of fundraising has all sort of placed pressure on different GPs. And I think as we said like before we started the chat today, most GPs are organized as partnerships. Partnerships are pretty good at taking investment decisions, but not so great at business decisions. And so you now have a whole bunch of businesses that are organized as partnerships. So actually, you can see where the problem lies. And part of it, and again, this is like my colleagues at Bain would say right off the bat, part of it is the hardest thing to do if you're in that GP role is to be able to clearly articulate an ambition and to get everybody aligned behind it. And actually, it's quite difficult to do that, to get to real clarity of ambition, and then alignment is hard. And alignment means really aligned. So it doesn't mean we're 75% broadly heading in the same direction. It's, we're 99 point something percent aligned. We know what we're going to do. We know what we're not going to do. And so we spent a bunch of time on these topics. And so it's as our firms have tried to figure out their future and trying to figure out what path they will take, the choice they will take, what will the archetype of that firm be? Will it, if it does one thing, will it stay doing one thing? In which case it probably has to do it really, really well.
Yeah.
Or will it start to develop other adjacent strategies to whatever the core was? And that's very topical, to try and, build a broader platform, build a more balanced business. If you're going to go and do that adjacent move, you're much more likely to do it through M&A, because the organic route just takes too long. You can't get there fast enough. So, and again, that opens up a whole new Pandora's box of how do we figure that out? And you see that right in front of your eyes every month or so. There's another deal done.
So to try and put myself in the shoes of like some kind of monoline, single product, very successful partnership, they just want to keep, the old phrase, sticking to their knitting. They just want to do what they're doing. I guess there's a couple of arguments to that, at least. One is that you might want to just do the same thing, but your environment is rapidly changing around you. And so at the very least, you become an ever smaller part of your ecosystem.
If you want to sort of stay in that mode, I mean, the other thing which I guess you have to think through is if the industry is broadly doubling on a 10-year view, and I mean, if Christian Sinden came to one of my classes on the business school and he basically said EQT's plan is to double and double again. Obviously, it's a big goal. But if you think about that, if the industry is going to double or perhaps more than double, if you're not doing that, then you're losing relative share.
Yeah,
right. And you're potentially losing relevance. So most GPs, if you say, well, actually your growth ambitions are such that you're losing relative share, it doesn't sit very well. You're becoming less relevant to the market that you serve, is not a great look. But if you want to stay, if you want to maintain that relative position that you have, which means doubling or more than doubling, then if you're doing one thing, then just think about what that really means. From a capital deployment perspective, you've got to double it. So you've either got to do many more deals, complexity, or you've got to do bigger ones, potentially different. What got you here won't get you there around your value creation playbook. So the interesting thing is, it's, one of the great sort of Bainey tools is future back. So go to 2033 and look, and where are you? What are you doing? And how will you define success at that point when you've doubled up everything you've done? And actually just maintaining that absolute level of performance and success at much, much greater scale is a non-trivial task. Quite a daunting task. But, better to sort of figure that out now than sort of sleepwalk into it and realize that actually you're not set up for whatever that means, whatever that requirement is. And there's a lot of that goes on.
Someone said to me recently, you've got to either be big or brilliant. And that leaves something for everyone, because if you don't want to be big, fine. You can be brilliant. And of course, there are those few that are big and brilliant.
Well, it's an extreme version of what might be a good characterization, but it's certainly, on big, I mean, the multi-strategy platforms have just got like horsepower.
Our supporter for this episode is Quest Fund Placement. In 2023, the firm launched Quest Invest, the digital hub and gateway to alternative assets that connects accredited investors with leading GPs. Quest Invest is the future of fundraising. It allows GPs to build their brand in front of a huge LP audience for ultra-efficient IR. Meanwhile, LPs have access to manager information in short, engaging video content. For more information on Quest and Quest Invest, visit questfundplacement.com.
They are just so much capability to sort of take mind space, head space with customers, and have so many ways of solving the needs of the customers that, I mean, that's a powerful thing. And if you want to be brilliant, if you are brilliant, that is fantastic. But I find that actually almost more daunting, which is you have to keep being brilliant. It's a bit like saying, congratulations, you've won the Olympics. Now you've got to win the next 3. Okay. The other thing with PE is the half-life of innovation is pretty short. So if you come up with something which is like secret sauce, it's quite difficult to build a moat around it. And the way that you can is, if you're great with data and analytics, you can probably codify what you know and help you make better decisions, etc. But there is definitely this pressure around building a model which is sustainably better, because it will get competed away with other new entrants coming in and people trying to steal the best of what you do.
One of my recent guests at Arena Investors said to me, he said, I don't want to invest. I just want to find money in the corner of the room and sweep it up.
Yeah.
And it's like, you don't, if you're reliant on being brilliant, that's a hard way to make a living in the long term, I guess.
Yeah, it's quite challenging. But I mean, I think that, maybe a bit of a paraphrase around that, but I mean, the way firms invest, it's interesting. Some of the ones I spend time with, they're very, very focused on what they do. They're very narrowly targeting the kinds of investments that they make, and they spend years incubating these things way before they ever become investments. It's a bit based around, these are the areas that thematically we want to invest in and we think we have a reason to be successful. These are the assets that sit in those areas, and these are the ones that we like. And we have no idea what's going to happen or when it's going to happen. But we do know that if anything does happen, our level of insight and conviction is going to be way higher. So we'll just move faster.
Yeah.
So we have an execution advantage driven by our knowledge and experience.
It's the inside knowledge point that you're making.
It's just like narrowing that focus and codifying what you know, to the extent that when you see something that if it becomes actionable, then you don't want to reinvent it all every time you do it, because you just can't bridge the knowledge gap. And therefore you should be in a better position to convert more of them, and that's what drives your success.
How do you think the manager M&A thing will pan out? Obviously the whole thing is rich in irony, because it's what they do for a living, but it's very difficult doing it for yourself with a partnership. Do you have any insight into how some of those are going?
Most of the ones I've sort of seen have gone all right. They've not all gone all right. It's probably about 80-20, I would say, that sort of right side of the outcome. And so there,
what is it that normally knocks it in the wrong direction?
People and governance.
Yeah.
People and governance.
Is it a succession tool as well?
It can definitely be. Actually, interestingly, most of the deals that are done are not private equity. The one that hasn't been done yet in private equity, which I think probably at some point will happen, is US private equity firm wants to buy European private equity firm platform. So geographic platform extension from the States into Europe. That hasn't happened yet. wouldn't rule that one out.
Mm.
For the most part, the deals that have been done have been mainstream private equity firms building into the adjacencies, and the adjacencies are something around infrastructure, something around credit, something around secondary PE are the big ones, and then you have life sciences as sort of an adjacent, another subset, because it's not so. The reason people like secondaries, credit, and infra is scalability, and also customer need. So the needs of the customers are less met, and these are asset classes, therefore, that can scale, grow faster. And you see many of the deals have been done across these three different broad areas, and you expect to see more of that.
Did you say life sciences as well?
Yeah, so people have done life sciences deals because it's an area, probably actually even post-COVID, an area of interest in the sense of it's relatively underserved.
So you're talking about sector specialist private equity?
Yeah, so you have
yeah.
quite often early stage, so growth investors,
Right.
early venture and growth investors in the life sciences space. But yeah, I mean, to some extent, I mean, on the other side, as people are thinking of what they do with their franchises, then clearly you have this challenge where, there's a point in time where owners make decisions about what they want to do with these businesses. And, if you've had a 20-year franchise and it's been fantastically successful, then one option is to double down and go for the next 20 years, and another is to not.
What about the wealth market? We touched on this 2 years ago and you thought it was going to be a big thing. Clearly is a big thing. What kind of inroads has the market made, do you think, into the wealth sector in the last year or two?
Lots and not very much. All right. So lots in that it's a lot bigger than it was a couple of years ago. And the number of players involved and the sort of product proliferation has all gone rapidly. Not very much because it's still relatively small. So if you look, I mean, the wealth, the amount of capital in that wealth market is very, very significant. It's, I don't know, 70 trillion, something like that is wealth, quote unquote. And we're scratching the surface still.
Yeah. Mm-hmm.
The vehicle of choice is the semi-liquid structure. There must be 40 now around the world. So and probably 2 years ago, there were 10. So there's huge growth in the vehicle archetype that is designed for this channel across multiple different strategies now. So there's the pure multi-strategy, there's secondaries, there's private equity, there's private credit, there's private real estate. So there's many, many more choices of vehicle and many, many more players playing at this.
What are your thoughts on a semi-liquid structure?
It's a bit Marmite. So people generally love it or hate it. There's not really much in the middle. I'm more of a lover. I think it's a pretty good solution, a pretty good tool. If it's the key thing is how it's positioned with the customer, because this is not liquid like a Diageo share. Okay, this is liquid with a small L, and you should think of it as sort of nuclear button liquid, right? There's a way out of this, but it ain't really day to day or even month to month. This should be seen. And again, it goes back to this point around in private markets, you really don't want to be pushing liquidity. You want the underlying to drive the liquidity, because then you benefit from the insider rather than you making that decision. So you should think about it as a somewhat liquid structure that gives you exposure to this asset class, which is obviously done very well. And when you've positioned accordingly and that's been communicated effectively, I think it's a really good tool. I was Mark Rowan, the great Mark Rowan, was speaking at the NBIM Investor Day, which is the Norwegian Wealth Fund. Which, by the way, they live stream that and it's on YouTube. It is fascinating. Just if you've got like a spare couple hours, go through all the presentations. They had Mark Andreessen, Mark Rowan, Howard Marks, like a rogues gallery of great people. And Mark Rowan was making this interesting point, which is if you're thinking about risk, if you think about the US public market, basically it's driven by 7 stocks. What's riskier? Yeah. Right. And if you're thinking about where you would like to invest, if you think about your S&P ETF, actually you've got 7 stocks that are all broadly in the same zip code in terms of their risk exposures. Or you could have a private market exposure vehicle. If you have like a private market vehicle, if you pick a multi-strategy one or a secondary one, it's probably got a couple of thousand underlying portfolio companies of all different shapes and forms. I mean, that's a very different risk bet to the index that's driven by 7 massive tech funds, tech stocks. Anyway, so I'm obviously completely drunk the Kool-Aid and I'm a believer. the people that hate it are just worried about, I think, partly the way the way the customers have interpreted what it really is, around the way liquidity works. Because of the liquidity, there's a mechanism for liquidity, which doesn't mean it's on demand.
Yes. Yeah.
Right. And that is interesting because, when I, many moons ago, when I was a public market fund manager, let me tell you, public market liquidity is also not not there when you need it.
Yeah.
Particularly in smaller businesses. The price you see on the screen is no relation to what you would trade at. So, similarly with this, the liquidity is not perfect liquidity. It just doesn't exist. Really,
it's a communication thing, isn't it?
Yeah.
You might be better off calling it a mainly committed vehicle rather than a partially liquid one.
What's good about what is good is the NAV exposure, right? So that as opposed to, you pass money to a private equity fund, it takes you 5 years to get invested, and who knows what your net exposure is. The great things with these things is you're NAV based, so you're straight into NAV the moment you invest.
You've got to have a certain scale as a private equity manager to be able to access
to build
this,
one.
To build this,
So the interesting thing around it is that they because of they're basically open ended, like mutual funds. So you have to start from somewhere, and then it scales with flows. So you're hanging your shingle out every month, going, this is open for flow, and you have to manage the flows into the vehicle carefully, because you don't want to crush the NAV with too much cash. So if you have too much flow in any month relative to the actual investment value, then you start to dilute the investment return because you've got too much cash. So it's a bit like there's like a pace you can go at, an equilibrium pace. And as you get bigger, you can take more money. You can grow faster as you get bigger because that equilibrium stays in place at scale. So the numbers get bigger.
And the more funds you got, the more you can allocate it out.
Yeah, well, the thing is, they're not really set up for funds. But funds,
do they not invest into funds though?
Only to a small extent.
So they're invested directly.
Yeah, this is the thing.
Right.
Because the problem is, like, the fund is, average life of private equity funds. 15 years average. Not good for liquid vehicles. Okay, so generally you want to be very, very thoughtful about the amount of long-term fund exposure you've got, because you haven't. It's difficult to underwrite the liquidity that comes out of that. So what typically you see is that these things sit below the deal funnels of very big deal machines. So, a private equity deal machine, a private credit deal machine, a secondary deal machine. And as deals go through the deal machine, then these vehicles are taking exposure from these deals as they pass. And I mean, the cadence is high. So, I mean, you're because you're open-ended every month, you're wanting to allocate to deals every month. And to do that, you need a lot of deals.
Yes.
Right? So even credit is great, because credit is like a fire hose of stuff that comes through it. So it's easy to do. Secondary PE is okay. I mean, there's lots of secondary transactions out there that happen. Depends how many you complete. The problem you have with secondary transactions is, from you saying yes to actually the deal funding, could be a long time.
Yeah.
Credit's much quicker. And then direct equity is sort of somewhere in the middle. So it's, there's a good flow, takes a bit longer to close, but, depending on how you set your vehicle up, is it multi-strategy? Is it private equity? Is it private credit? Is it whatever? What is it? It's got to sit under a deal funnel, and then it's got to transact, or it's got to pick from that deal funnel on a pretty regular cadence. And that's what builds your vehicle.
Yeah.
So, so far so good. So far so good. But as I said, some people find them a little more challenging, just around, we've not really seen a proper pressure test. Yes. And so some are more cautious. Some individuals are more cautious around wanting to see that. But I think they're here for good, and they're going to get a lot bigger.
I guess I'm more of a idealist, purist. I like for example, the investment trust structure. You're chairman of the HG Capital Trust. It just makes such a perfect structure for illiquid assets, because you're never going to be under pressure to sell in a way that you could be if you're promising yield or something different.
Yeah, I mean, it's interesting on investment trusts or investment companies. Do you know how many there are?
Probably not many anymore.
600.
Oh, okay. Go on then.
Okay, so there's an awful lot of investment companies, and there's maybe 30 or 40 private equity ones, and there's a few others around the edges. And And yeah, I mean the closed end structure is great around, you have a fixed perimeter. You don't have to worry about the perimeter particularly. You just have to manage within it. So, the way HGT works is effectively it's the biggest investor in the HG funds. So we've actually parallel structures into their funds, but we have investments in their funds and then we do co-invest alongside. And what we're continually doing is sitting there going, what is our balance sheet? And below the balance sheet, there's a revolving credit line, which is our sort of additional funding capital if we need it. So what is our balance sheet? What is the NAV that we have across all the different investments that we've made? What's the profile of new investments that are coming in? What's the profile of investments that are going out? And what's the net outcome of that? So what's our net cash in, which is easy because it's proper cash in. Net cash out is how much is coming out to us versus rolled over. And then what commitments are we making to future HG vehicles? And so that is, if you look in the board pack, every time we talk as a board, it's there's a set of slides that everybody just jumps to right away, which are those ones, which are, what's this picture? And the only thing we know with a model is whatever single point estimate we get is going to be wrong. So we are continually thinking through where are we in all this stuff and have we optimized it? And we continually sort of go round and round in circles. And you actually can optimize it, right? Because you always have to, there's a margin of error that means you can never get to perfect. So you just have to think through how close are you to what you think optimal is and how much risk do you want to run? Because, we can like all these structures, we can bend it into a position where it's going to be risky. Yeah. But we don't want to do that. So
by overcommitting.
Yeah, exactly. And I mean, we uniquely with us, we can't really hurt ourselves in overcommitment because of the way we're structured. Because we have with HGT an opt-out right. So we have a non-recourse opt-out right, nice. Which means it's just sort of that. It's our final line of defense, basically. I mean. But the way we think about liquidity, we have and it's actually not a bad way to sort of parallel to the wealth topic. We have a thing called the liquidity staircase. So liquidity staircase is how many different ways have we got to solve for liquidity at any point in time. And there's several steps in the staircase, and the last step on the staircase is the opt-out, which is if we really can't solve this any other way, then ultimately we can use the opt-out and we're fine. But it's a bit like the king vetoing an act of parliament, right? I mean, you don't want to use that other than in absolute extreme circumstances. But then as we go back up to the staircase, okay, how many other different ways have we got? If things get a bit tight, how many other ways have we got to solve the problem? So we have we can sell fund commitments. We've done that before. We've got we sell co-investments out of our co-investment portfolio. We've done that before. There's lots of different ways that we can solve it. So, within the public company construct, all we're doing is saying, where are we? Where are we going? Is it trending in the right direction? And let's play tactics as well as strategy. So if we need to do something because we feel like we're getting into an uncomfortable position, then we've got lots of different choices. And let's, what you don't want to do is run out of time. So let's make these choices in a way that mitigates the risk of anything nasty happening or us getting too far down the staircase of liquidity. So that works. And so HGT 1989 was its establishment, because HG used to be Mercury Asset Management. That's where it all came from. And it's chugged along. Results are today, actually, as we're recording to this. So it's at one level amazing. So 17% NAV growth every year for 20 years. All inside that listed structure. It's been great. The trick with the listed vehicles is it's quite, if you can scale them organically, that we obviously have. That's been great. They're quite difficult to scale inorganically, right? Because to raise money, if you want to do that, to accelerate the pace of growth, then you've got two challenges. One is if you raise it, you've got to figure out how to deploy it. And that's not so easy. If you get big and incremental lumps of capital, it's not so easy to deploy.
Yes.
Yeah.
Unless you had a multi-manager approach.
Right, which we don't.
Yeah.
So
but one could if one was in that position.
Yeah, but even on that though, so even if you were a multi-manager, if you had to deploy a lot of capital fast, then if you're a multi-manager, you're making commitments, and they'll take time. So so if someone says
coordination problem.
Yeah. So that's not so easy to actually solve
So you
these.
can't just do a rights issue, end up with a load of money. And,
Well, with the rights issue, that's the second problem.
Oh.
So they sort of got these things the wrong way around. The first problem is actually raising money through rights issues or they're called C-share issues for investment companies is hard because you can't really do it if you're trading at a discount to NAV because it's not in the interest of the company, the shareholders, to do that. So you can only really issue equity when you're at a premium. And these things don't trade at premiums very often. They do occasionally, but not very often. They're typically, and right now, the opposite problem. They're trading at big discounts. So, you have a difficult job raising capital other than if your shareholder, or rather your share price NAV ratio is the right way around. And even if you do have it the right way around, you better be careful how much you're raising because then you've got to deploy it in a way that's consistent with your objectives and also deliverable, hard. I mean, you look at that and go, you can see why there are not more of these things.
Yes, you can.
But what is interesting around it, though, is if you think about the wealth channel, the sort of four big buckets of it, ultra high net worth individuals, very high net worth individuals, high net worth and mass affluent. Ultras are already served by feeder funds, right? So these are very, very wealthy individuals and families who are writing commitments to funds through feeder programs. Then the next two are the purview of the semi-liquid vehicles. So very high net worth and high net worth. The mass affluent as yet unaddressed because the challenge there is that if you're in the semi-liquid structure, then you have to pass a bar as an investor, as a qualified purchaser of the individual asset, which means all sorts of rules around your wealth and your income level and your level of sophistication. And then the minimum tickets for these things are, you might get it down to £20,000, but you're not going to get it much lower. So it's still really material. Yeah. And that eliminates the mass affluent for all these different reasons. So the mass affluent solution, what you're doing there is if you're trying to solve for it, you're taking the regulatory burden away from the individual and you're passing it to the vehicle. So, HG Capital Trust is main market listed on the LIC. All you need to do to become a shareholder is £5. Right? You're a shareholder in a listed entity with an independent board on a public stock market. Fine. So that solves that problem for the mass affluent. And at the moment, not many other things do. So the next step on the wealth channel is how will that get solved? So because basically the push to wealth, the ultras are covered, and then the next two buckets down are broadly covered as well with the current structures. What happens to the mass affluent? How do we really nail that? What will technology do? And maybe it's something clever like blockchain, right, or tokenization. Maybe, certainly because the size of the prize is enormous. Because that wealth pyramid is a big pyramid. It's got a very flat bottom. Yeah. So there's a number of customers you could address if you could develop something that really worked at that level. Is very large, but no one's quite got there yet. And there's sort of enough meat in the middle that that's where people are attacking because they haven't really figured out how to do the mass affluent yet. And so at the moment, the one way you can do the mass affluent is through the listed vehicles, but there's just not that many of them.
Yeah. Let's talk about private equity value creation. Here's one for you. ESG just seems to go, certainly in Europe, up the agenda, certainly in kind of marketing terms and investor communications terms. In terms of returns terms, what do you see from ESG? How do you view it?
Well, I mean, it definitely in terms of up the agenda, you better believe it. And I think it's two forces combining. So one is I think there is a value to being a leader in that area, which is two things. One is I think the value that others ascribe to a company that follows that agenda or has a much more prescriptive process for following that agenda is higher because it's deemed to be a business with a better long-term future if it follows it. And the other thing is absolutely talent. So that if you have the right body position on that topic, you have a definite advantage in recruiting and retaining talent. And these two things sort of go hand in hand. And then obviously the other side of the telescope, investors are saying, well, we just expect this as table stakes. And we are just going to demand more and more, certainly a degree of conformity and arguably more so all the time, certainly more tracking. It's a different part of the toolkit. Because if you think about when you're doing value creation plans and trying to figure out full potential, etc., I mean, there's a whole bunch of sort of very obvious things that you look at, which is a market position, pricing power, adjacencies, product, markets, companies, M&A targets, all the above, capability, human capital, and it all it's woven into it. But it's if you like, it's you would, I think, fair to say people probably look at the sort of business dynamics and then this, rather than this and then the business dynamics.
It's everywhere. And the way you frame it is actually very interesting because you're looking at the upside and you're looking at, like, so it's re-rating, rating it well, and talent. The way it's been historically described is more on the risk side, though. So, ESG risks, we're making sure that we're kind of covering our downside. And that's never, so what you said is convincing to me. The risk argument has never been that convincing. If you look at kind of like an ESG report, it's very rare that a portfolio company will report an ESG risk that has hit, the financial performance, with one exception, and I'd say that's cybersecurity.
Yeah,
I think you're constantly, in fact, I think cybersecurity is the elephant in the room.
Yep.
Just
Never
in the corporate world in general.
Yeah. Yeah. Well, I mean, HG, we've got 50 odd assets all on the cloud. So for us, I mean, if you look at our risk register, there's 50 things on the risk register. This is the reddest of the red.
Yeah.
Cyber.
Yeah.
One of our jobs, we're paranoid about we get this wrong. The board's paranoid about getting it wrong, and we continually ask, what are we doing? How do we solve this? And what can we do to lead the thinking? And the answer is, you probably can't eliminate the risk. What you're predominantly trying to do is mitigate the effects of it.
Yeah.
So reduce to the greatest extent possible your exposure to potential threats, and if anything does happen, firebox whatever it is so it doesn't spread.
Yes.
And that's kind of it.
Are you seeing anything cool being done with AI in the private markets world?
Oh yeah, HG's an OpenAI development partner. Has been for a while. So we got really excited about ChatGPT 4, and they went, yeah, we've been working since 2. So okay, nothing to see here. And that's just one example. But I think in different areas, so you see portfolio companies working around things like Salesforce effectiveness, customer engagement, process efficiency, so things like scanning of documents. And so you would see that in value creation. And then on the deal side, there's work that's been done, and useful work that's been done around helping make better decisions on deal pipeline. So Christian Sinding was talking at LBS around the way they use Motherbrain now. When deals come through the EQT pipeline, an AI tool screens against the deals that they've previously done, and the tool knows the key characteristics of what success looks like, and immediately screens for the same characteristics in deals coming through the pipeline. And so it doesn't tell you what to do and what not to do. It just basically says, this has got, of the 7 things that have really driven our returns in previous deals, this has got 6 of them. So take it really seriously or not. So you begin to see that on the deal side.
You've got to have done enough deals to be able to.
Yeah, it's kind of a data business.
Yeah.
What is a data business? And then there's some, again, LP relationship stuff as well. Have we got the right segmentation of our customers? Are we, who should we be showing what to at what point?
I mean, it's probably just a starting point, a talking point, an selection process, but even so, pretty powerful one.
Yeah, and if you've got a really good tool, tell nobody. Right? I mean, you don't want this to be in there, because as soon as you sort of march around going, we've got a brilliant tool, like, fantastic, we'll just copy that then.
Yeah.
So, there's an interesting dance around what you do and what you say you do and how you integrate that into the results that you create.
This is your 3rd appearance on Fund Chat, but I've never really asked about the Jim Strang phenomenon. Like, if I was in my 20s and I wanted to be in like finance, or particularly private equity, I look at you. You've really experienced many facets of the industry. How did you kind of start out and get to where you are now, if you could put it into kind of a nutshell?
Oh dear. Well, 3rd time I get to keep the trophy. Right. So, I mean, my father used to say, if you ever write your biography, you should call it The Path of Most Resistance. So I started out, bizarrely, I decided I wanted to do a PhD. And so I was working doing a PhD while I was a fund manager. And a good chunk of my PhD was, so my PhD topic is a big question of finance number 6, which is IPOs. So the price performance of IPOs is a massively studied phenomena. And the basic premise of it is that, you know, IPOs have a certain performance profile, which if you did the same thing every time without thinking about it, you shouldn't make money, because that would be a disequilibrium, and we believe in the equilibrium theory, so that you can't do that. But if you do this with IPOs, you make money. So what's going on? As you find out quite quickly, the reason is the things that you assume to hold true don't hold true. And then within that, there's a private equity-backed IPO phenomenon, which is private equity-backed IPOs have a pattern within a pattern. And when I was studying this, I kind of got interested in the industry. So in PhDs back in the day, I had a study buddy. My study buddy is still a partner at Bain. And she went off to Bain. She was 6 months ahead of me. She went off to Bain and went, if you're really interested in this private equity stuff, you should call Bain, because they do loads in private equity, even in the 90s, loads of private equity. You might find it interesting. So anyway, off the back of her recommendation, I scooted off down to Bain and got mesmerized and ended up in the private equity group. And even then, we did all sorts of fascinating stuff. And out of Bain, when I'd sort of done my 3-year stretch in private equity and crawled out the building, I had 2 or 3 different options for things I wanted to get in, I could get into, and one of them was to join a sort of an asset manager, which had a private equity program, and I quite liked that because I'd done a bit of time in asset management when I was doing my PhD. I'd done my Bain's time, and this was sort of a bit of a startup, and that is now what is called Hermes GPE. So I went there, and got into it that way, and then sort of went through that business. Ironically, it got bought by Hellman and Friedman.
Did it?
Yeah, Hellman and Friedman bought it. The original business bought it and took it public, which is again funny for someone doing their PhD in IPOs. And then eventually, you know, with a few twists and turns, I ended up at Hamilton Lane. Spent, you know, a bit more than a decade at Hamilton Lane, and then got into my new world a couple of years ago, where I've got a bunch of board roles, well, a bunch of Bain time, and then I've got my London Business School back where it all began. Annoying students, where I used to be one of them.
Amazing. And you got Business Growth Fund as well, which does that take you?
Yeah. So when I was doing building my board portfolio, I wanted something which was more than just a sort of a bottom line focus, right? So yeah. BGF's role is, it's an amazing business. It was created at post GFC to help drive scale ups in the UK. Wind the clock forward 12 years, and we've got 500 portfolio companies, all UK, all SME, all growth orientated, everywhere from Wick to Wolverhampton, and everything from burrito bars to cyber firms. But the idea is, you know, make money, but also generate growth, employment growth. So, and it's a really interesting business, and I mean, it's what is amazing around it. I don't think anyone will ever get given the opportunity to do what they were given the opportunity to do, because effectively through the funding structure, so it's funded by, there's 5 shareholders who are UK banks. It was given a very, very large balance sheet and told to go and operate in a particular model, and no one's ever going to get given that again. And that's allowed it to build a real machine. And it does stuff. It does good stuff.
And so, surprisingly enough, we have actually quite a lot of younger viewers, and so I've been asked to ask a TikToky type question.
Oh Jesus!
Which is, you know, if you were starting out now and you wanted to still get into private equity because you're interested in it, would you have any advice for someone, you know, in their 20s?
Yeah, I get asked this question about 200 times a year. Sort of 200 students at business school all trying to do the same thing. So, I mean, I think, you know, I just reflecting a bit on it, I think the things to think through, it's such a diverse industry now in every sense that you need your narrative for which bit of it is your bit, right? Because it's a way different thing working for EQT as it is working for BGF. Right. So what is it that makes it work for you? And what's your story going to be? Right. So where would you want to sit in this ecosystem, and why does it make sense? Because people generally stay in the ecosystem that they move into. So, you know, you don't see very many people at BGF joining Bridgepoint, right? Or the other way around. I mean, and if there is a staircase, it goes down, not up.
Yeah.
right? But people tend to be kind of ecosystem because it's still very driven by relationships, and you build your relationships in an ecosystem and your reputation, and actually that's what becomes your stock in trade. So being really thoughtful about what's the right place to start is definitely helpful.
And that's a kind of a cultural / personality type decision.
Yeah, I mean, like, some of the obvious ones are, small companies, like small buyouts, for example. There's much less management bandwidth. You're much closer to the business. You're probably doing more in a smaller fund. You'll have much more visibility, and there's more volatile outcomes. Bigger funds, I mean, it's fantastic learning environment, massive franchises, and huge support and learning networks. But the businesses you're working with are way, way, way bigger, and your role is going to be different, and so over a period of time. It just depends what you want. Venture is actually quite a difficult business to enter as a young investor, because a lot of it's based around judgment and network, which you struggle to build, or you struggle to credibly point to. Credit is very different to equity. It's more of an underwriting mindset, different set of skills. And then you've got secondaries, again, different to private equity. You're not the deal process is different. It's a different methodology. So there's a whole lots and lots, and this is what we do with LBS, is we try and give people like the tip to tip view, and go, okay, well, we're going to try and show you the whole thing, and then you will kind of figure out which bit of it that you feel is the most relevant for you, and then you go to school on the bit that's most relevant, and you think about your narrative. Or one of my colleagues calls it the golden thread, right? What's the golden thread that runs through your history and gets you to the door of whatever firm you think you want to work with? And then what's your value proposition personally, right? Because one of the great things and one of the worst things about the industry is it's full of amazing people, right? So I mean, there's not very many people who are not quote unquote amazing. So what do you bring? And the best thing to bring is something that they need that they don't currently have. So when I did this 20 odd years ago, being a strategy consultant was awesome because they didn't have strategy consultants, right? It wasn't part of the industry makeup in the early noughties. Now it's pretty pervasive, right? Most people know what these people are and have got some exposure to them one way or the other. So what would the skill set of today be, right? And I mean, it's probably something around technology and digital, and knowing how to speak the language of that, and that would be additive. And then network, right? So if I think about my LBS classes and people that move through them, like these roles aren't popping up in the FT or on LinkedIn. They are finding them. It's a trust. Industry works on trust, and that's how you build trust, are through strong network relationships where you've given more than you've gotten. And that's an important part of it.
That's great advice. If you want, I can clip that for you. So every time you're asked the question, you can just send them that.
I've definitely I've played this movie before. It's not the first time I've had that question.
Brilliant. Well, thanks so much for coming in for a third time. Look forward to the fourth, and best of luck with all of your many endeavours.
Thank you very much for having me. Pleasure to be here, and see you soon.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.